Bismillahirrahmanirrahim. Today's our topic is about the fundamental concepts of equipment economics. We have previously discussed about the value engineering and earned value management system and the end value. But today we will focus more on how we are going to deal the economics related issues for the equipment. A basic, correct, and complete understanding of the cost that results from equipment ownership and operation provide different companies a market advantage that leads to higher profit, greater profits. Um, Ownership cost is the cumulative result of those cash flows and owner experience, whether or not the machine is productively employed on a project. Similarly, operating cost is the sum of all those expenses and owner experiences by working a machine on a project. So these are two different concepts, the ownership cost and the operating cost. Similarly, the process of selecting a particular type of machine for use in constructing a project requires knowledge of the cost associated with operating the machine in the field. There are three basic methods how we can get a machine for our project, which we will discuss in the next slides. Basically, equipment economics when we are dealing with the equipment economics, we have two basic questions. How much does it cost to operate the machine on a project? And what is the optimum economic life and the optimum manner to secure a machine? Equipment cost is often one of the contractor's largest expenses categories, and it is a cost with different variables and the questions. To be successful, equipment owners must carefully analyze and answer these two questions separately. The first question, that how much does it cost to operate the machine on a project, is critical for bidding and operation planning. The only reason for purchasing equipment is to perform work that will generate a profit for the company. This question seeks to identify the expenses associated with the productive machine work and is commonly known as ownership and operating cost. The ownership and operating cost is usually expressed in machine operating per hour, that how much it costs per hour. Because it is used to calculate the cost per unit of the machine production. For example, if a machine, we can say a dozer can push um, a certain amount of the earthwork, for example, 400 cubic yard per hour, and it has $100 per hour, say the operating ownership and operating cost. So the production cost would be the 500 cubic yard. We will divide the cost, the 100. So the production cost we can get simply by dividing these two costs. Similarly, the estimators or the planners can use the cost per cubic yard to figure directly on the unit price. For example, on the lump sum project, it will be necessary to multiply the cost per unit price by the estimated quantity to obtain the total amount that should be charged. Similarly, coming towards the second question, that what is the optimum economic life and the optimum manner to secure a machine? Uh, this question seeks to identify the optimum point in time to replace a machine and the optimum way to secure a machine. This is important in that it will affect the ownership and operating cost, and it can lower the production expenses, enabling a contractor to achieve a better pricing position. The process of answering this question is known as replacement analysis. These two questions require different inputs and experience of how many expenses and the operation factors are there. These input factors we will discuss um, in the further slides. As I mentioned earlier, that there are three methods which we can use for securing a machine. Whether we can buy a machine, like a contractor can buy a machine, and he has its ownership cost, um, and then he can rent a machine. And he can rent out a machine, and there are definitely the operating costs. And the third method is that he can lease a machine. The equipment record whenever a contractor buy a machine or rent or lease, the records should be maintained properly. So forward, these records should be collected and maintained so that they can evaluate the performance of a machine, how the machine is performing, um, to establish the operating cost, what is the operating cost, and analyze the replacement questions. As I said earlier, that um, it, it it gives the opportunity, and we can do the operational analysis uh, to answer this question. Similarly, how we can manage the project. Data on both the machine utilization and the cost are the key to making rational equipment decisions. We have discussed about the rational decision making. The collection of the data, like in the individual pieces, is the only first step. The data must be assembled and presented in a usable format. Many contractors recognizes this need and uh, try to collect and maintain accurate equipment records for evaluating machine performance, establishing its operation cost, analyzing replacement question, and managing the projects. Surveys, like the different surveys of the industry's practices, shows that these efforts or these practices are not universal. Realizing the advantage to be gained from these maintaining the records, owners are paying more attention to accurate record keeping. Similarly, advances in computer technology have reduced these efforts required to implement the record. As with the emerging technologies, it's more easy to maintain all the records. Similarly, automation introduces the ability to handle more data economically and in shorter time frames. But the basic information required to make the rational decision and record keeping is the standard approach. Under such a system, jobs are charged, standards machine utilization for every hour the equipment is employed. Machine expenses are charged either directly to the piece of the equipment or separate equipment records. The level of detail for reporting equipment use varies. Both depends on services vendors and the equipment companies. As a minimum, data should be collected on daily basis to record whether a machine worked or was staying idle. A more sophisticated system will seek to identify use on an hourly basis, accounting for actual production time and categorizing idle time by classifying such as standby, down weather, or down repair. The input for either type of the system is can be easily incorporated into regular personal timekeeping reports, with machine time and operating being and the operator time being reported together. Most of these information are required for ownership and operating or replacement analysis are usually available in any company's accounting record. All the owners keep records on a machine's initial purchase expense and final realized salvage value. We will discuss about the salvage value in our coming lectures, that what is salvage value, how it is calculated. So we were discussing that uh, usually the contractors or the owners of the machine have a record of the initial purchase expense, how much they have spent on buying that equipment or that machine, and what is the final salvage value. They also use it for the tax filing. Similarly, the maintenance expenses can be tracked from different timesheets, like which parts they have ordered, how much they have paid to the mechanic, and similarly, the other one important thing is about the fuel expenses, like how much fuel it has spent and how much work it has done. So the fuel amounts can be cross-checked against the total amount of the fuel which was purchased. So all these things can be combined and put to the analysis, which increase the accuracy of the equipment cost analysis greatly. Similarly, the time value of the money, it is a very important concept in the economics. It can be simply defined as it is the difference which must be paid if one borrows some money for a use today and returns that money at some time in future, some point in future. For example, the worth of money today is, for example, somebody borrows $100 or 100 rupees today. So after 1 year, what will be the worth at that point? So we have to calculate it. So that's the time value of the money. So what commonly refers to the time value of the money is the difference, or in our case we can say the rent that must be paid if one borrows some money for use today and returns the money at some point in future. Many takes this advantage for granted, as the so the rent which we have discussed, that the difference is the rent. So this rent or the added charge is usually known as interest. We will discuss about the interest. So basically, interest, how we can define it? It is the profit and the risk that a lender applies to the base amount of the money that is borrowed. If someone is lending the money to the other persons, so he applies its profit and the risk which is involved during that time. So usually it is expressed as the percentage of the amount borrowed, which becomes due and payable at the close of each billing time period. The billing time period usually is stated as year. It can be less than that, it can be more than that. It depends on the type of the contract in which these two people enter. So let's take an example of the interest. For example, $1,000 are borrowed at the interest rate of 8%. So then the interest per year would be 1,000 multiplied by the 8%, 8 divided by 100.08, which comes out to be $80. So this is the interest. this cost $80 is the interest per year. So $80 is the interest plus the original cost $1,000 is owed after 1 year. So the borrower would pay $1,080 at the end of 1 year because the interest rate was 8%. If not repaid, the interest for the second year would be calculated based on the new total amount 1080, because after 1 year this 1000 has become $1080, and thus the interest would be compounded. Similarly, after 2 year period, the amount that would be paid back would be $1080, which is after 1 year, plus $1080 multiplied by the 8% of the interest. So the total amount which would be which a borrower have to repay is $1,164.40. If we see all these figures, so $1,000, 1080, $1,080, and $1,166, these all are these all amounts are equivalent. These three amounts are obviously not equal, but they are equivalent. So here we have to know that the concept of the equivalence involves time and specific rate of interest. So at the beginning of the year, it was $1,000. With the interest and passing of 1 year, it has become $1080. So all these three amounts are equivalent but not equal, because the equivalence involves the time and the interest. These three amounts are equivalent only for the case of interest rate of 8%, and then only at a specified point in time. Equivalence means that one sum or series differs from another only by the occurred accumulated interest at the rate I and n period of the times. In order to generalize the concept of interest, these symbols we will be using in our lecture. The present single amount of the money, like the present worth of the money, we will be denoting it with P, and the F would be used for a future single amount of the money after n period of the time. It can n is the number of the time period. It can be 1 year, 2 year, 3 year, and the interest rate would be denoted by the I. The rate of the interest per period of the time, usually 1 year, is denoted by the I. So the different situations involving an interest rate and time uh, will be presented in the next slides, and also the appropriate analytical formulas will be developed. So to calculate the equation for the single payment, for the future value which we have said F of a single payment, P like the present, of after n periods at an interest rate of I, the formulas which are used are as under. At the end of the first period, like n equal to 1, F1 would be equal to P plus PI. Like the P is the present worth. For example, in the previous example, as we have seen, this is 1000 plus this is the interest on the present worth, for example, the $80 as we have seen in our previous example. So 1000 plus 80. So this would be 1080. So let's discuss further. So at the end of the second period, n is equal to 2. F2 is equal to P plus PI, similar as this, plus this formula. P plus PI, the interest, the whole bracket of the interest. So we can also represent it with the simple formula like P bracket 1 plus I whole square. So at the end of the nth period, we don't know how many and sort of how many periods are involved. For example, 6 years, 7 years, 8 years, 9 years. So this n would represent the number of the years in those cases, and the I would represent the interest. So interest per year. So with this formula, we can calculate for any number of period. So our future single payment, this equation A, we have to remember this equation, and we will be using this equation in our future examples. Here we have to know that the F is related to the P, like this F, like the future amount is related, future single amount is related with the present single amount by a factor which depends only on I and N. So this factor is termed as single payment compound amount factor, or SPCAF, single payment compound amount factor. And this makes this single payment compound amount factor makes P equivalent to F, or F equivalent to P, but these are not equal but equivalent. Similarly, if the future amount F is given, the present amount can be calculated by transposing the equation A. This equation, we just have to transpose and find the value of the P. So P is equal to F over 1 plus I interest with the bracket of N. This factor 1 over 1 plus I whole n is known as present worth compound amount factor. So these two equations, like, we have to remember this, like this is for when we have to calculate the future amount, but we have the present worth. But this equation we will use when we have the future amount, but we have to calculate the present worth. This factor is important, which is known as present worth compound amount factor. We will be doing some examples now so that we can uh, know the concept and how we can use these two equations. The equation of the single payment compound amount factor, and the present worth compound amount factor. So how we can use these two equations, we will be discussing now. So let's discuss some of the examples related with this. So in the example one, let's see. If a constructor wishes to borrow 12,000 US dollars to finance a project, the interest rate is 5% per year. If the borrowed amount and the interest are paid back after 3 years, what will be the total amount of the repayment? In this question, if we see, so this is the present worth, $12,000. I, the interest rate per year is 5%, or we can say 0.05, and N, the number of the years are 3. So we will use the equation A, which is also known as single payment compound amount factor, SPCAF, to calculate the future worth after the 3 years. What will be the amount which would be used for the repayment? So we have to use the equation A as we have discussed earlier. So 12,000 is P, and we have the formula 1 plus I power n. So I here is 0.05 and n is 3 years. If we calculate this, this comes out to be 1.1576. So we have to multiply it with 12,000. So we get 13,891 dollars. This is the future amount which would be repaid if a person borrows, or if a constructor borrows $12,000 to finance a project at this stage right now. So if we want to calculate the interest, so what would be the interest? We have to subtract this 13,891 from 12,000, so we can get 1891. So this is the interest which the constructor would pay after 3 years on $12,000 which he has borrowed. So in this example, we have seen and we have used the formula of single payment compound amount factor. This formula we have used. Similarly, let's see another example. If a constructor wants to set aside enough money today in an interest bearing account to have $100,000 5 years from now for the purchase of a replacement piece of equipment. If the company can receive 8% per year on its investment, how much should be set aside now to acquire $100,000 5 years from now? So in this example, if we see, so 100,000 is the future amount, like F, after 5 years, which a constructor wants to have in future. So in this example, it is asked that how much a constructor should have right now, which he should put in a bank or with a company where he can receive the interest. So if the interest rate is 8% per year and we have the n 5 years, so how much he should put aside to get $100,000 after the 5 years? So we have to use the equation B, which is also known as the present worth compound amount factor. So in this case, we have the future amount F, which is $100,000. I is 8% and N is 5 years. So we have to use all these. We have to put in equation B and we have to calculate the present amount. So 100,000 F divided by 1 plus 0.08, 8%, and 5 this N. So we have to calculate this. When we add this and put the power, so we get 1.4693. So we have to divide it by 100,000. So the present worth or the present amount which the constructor should set aside or save right now in a bank or a deposit is $68,058. If he save this amount in with the interest rate of 8%, he can get $100,000 after the span of 5 years. So in these two examples, we have seen the single payments now, and how these are equated with the future, which involves P present value, F future value, I interest, and N period. So given any three of the parameters, the fourth can easily be found. Like any of these, we have four parameters: P, F, I, and N. So if we have any three parameters, we can easily find the fourth one. So now let's discuss about different formulas for the uniform series of the payment, because previously we have discussed and seen only the single payment. As often the payments or the receipts occur at a regular interval of time, and such uniform values can be handled by using different formulas. So let's first introduce another symbol, which is A. Previously we have introduced four symbols, which were P, F, I, and N. So now another symbol, which is known as A, is uniform end of period payments or receipts continuing for a duration of n periods. So these are the uniform payments which can be made at the end of any period, like at the start of period or end of the period. So if this uniform amount A is invested at the end of each period for n periods at the rate of interest I, as we have previously discussed, per period, then the total equivalent amount F at the end of n period will be calculated by this formula. So using this formula, we can calculate the future amount when A, which is the uniform and period payments, are regularly injected. So now multiplying, so this equation which we have discussed, we can is the total equivalent amount F at the end of n period. So now let's multiply 1 plus I to the both side of this equation. So multiplying both sides with 1 plus I, we obtained this equation. So now we have to subtract the original equation from both sides of the new equation. This original equation we have to subtract from this equation. So if we subtract this equation from this equation, we get the new equation. Fi is equal to A, the bracket 1 plus I power n minus 1. We can rearrange uh, this equation. We can find out the value of f. So if we rearrange this equation, we get a new equation, which here we can name as equation C, in which we can find the future value or the future worth, which is equal to A, the bracket 1 plus I power n minus 1 divided by I. This relationship, this new relationship, it is also known as uniform series compound amount factor, or USC CAF. So this new relationship is known as uniform series compound amount factor. So this relationship can be rearranged in the other form, in which we can find out the value of A, as A is the uniform end of period payment or receipt continuing for duration of n. So we can also find the value of A if we rearrange our previous equation, which is equation C. This equation, if we rearrange, we can find the value of A. Like, we have just to divide this on the other side, or take this value on the other side, so we can get the value of A. So this relationship is basically known as uniform series compound amount factor. Similarly, if we inverse this relationship, so it is known as uniform series compound amount factor. This is uniform series compound amount factor. But if we inverse this relationship is known as uniform series sinking fund factor, or USSFF, because it determines the uniform end of period investment A that must be made to provide an amount F at the end of n periods. So I would repeat this relationship I over 1 plus I power n minus 1 is known as uniform series sinking fund factor, or USSFF, because this relationship determines the uniform end of period investment, which is A, uniform end of period investment, which is A, that must be made to provide an amount F. This is the amount F at the end of period N. So at the end of period 5 years or 3 years, what would be the value of the F? We can find out by this relationship. In order to determine the equivalent uniform period series required to replace a present value of P, we have to substitute equation A for F into equation D. So let's see what's the equation A and what are the equation D. So this is the equation D. So here we have to put the value of F in terms of P. So we can take it from equation A. So this is equation A, which we have earlier used. So we can put the value of F from this equation A into our new equation. So we have just to put value of F in terms of P here, so we get this new equation. So this relationship is known as uniform series present worth factor. So we can also use this equation. So, or we can also invert this relationship, and we can find the value of A in terms of P. So these all, like, we have introduced a new factor A, so we can play with P, A, F, so we can find out whichever value we need. So this relationship is known as uniform series present worth factor, or USPWF. So we can also invert this relationship and find the equivalent uniform series end of period value A in terms of P. So the equation would be A is equal to P bracket I plus I power n, I plus I power n minus 1. So this relationship is simply the inverse of this relationship. So we can find out value of A. And here, this relationship is known as uniform series capital recovery factor, or USCRF. So, so we have these 6 relationships which we will be using in our coming examples and the questions. So as an aid to understanding these 6 um, uh, relationships, or the preceding equivalence, we can say it equivalence relationship, these 6 equivalence relationships, the appropriate cash flow diagrams can also be drawn from this. So for example, this is a cash flow diagram in which we have the initial present investment, or the P value, then with a period of time like that, and we can find out the future amount with this formula. F is equal to P into this, the equation A, we can say. Similarly, if we have the future value, if this value is known, we can find out the value of P using this relationship. So this is the cash flow diagram. Cash flow diagrams are the drawings where this horizontal line represents the time. This horizontal lines represent the time, whereas the vertical arrows, the vertical arrows, these represents the cash flows at a specific time. So if we have an arrow up, so it means it is a positive cash flow. If we have the arrow down, so it means it's negative. The cash flow diagram we can see in this example. These relationships form the basis for many complicated engineering economy studies involving the time value of money. So let's see some other cash flow diagrams. So this is other cash flow diagram when we have introduced the new component A. So here we can also see this relationship that we have a investment, or the cash flow at a specific period of time, or at the or a uniform period of time, or we can say a uniform end of period payment or receipt, which is continuing for the n periods of time. So with this we can find out the relationship of f, we can find out the f, or we can find out the a using this formula which we have seen earlier. So similarly, in terms of p, we can also the present value, we can also choose this formula to calculate the value of a or value of p, whichever we have. So most engineering economy problems are more complicated than the examples which we have considered, and uh, these must be broken down into small parts. So for this, we can consider another example, a more detailed example, to see how we can use these relationships, or and how these relationships are beneficial. So let's see the example number 3, which we have. For in this example, for example, we have a machine which cost is $45,000 to purchase. Fuel, oil, and grease, we can say FOG, and minor maintenance are estimated to cost $12.34 per operating hour. So here the machine cost is $45,000, the purchase cost, and 12.34 is the operating hour for fuel, oil, gas, and other minor repairs. Those are when the machine engine is operating and the machine is doing work. So this cost is not in the ideal condition, not in the when the equipment is idle, but when it's working, like it's operating. A set of tires cost $3,200 to replace, and their estimated life is 2,800 use hours. So it means that after every 2,800 hours, we have to replace the set of tires, which cost is $3,200. Similarly, uh, 6,000 major repair will be required after 4,200 hours of use. So after every 4,200 hours, we have to invest the amount of $6,000 for the major repairs because of the wear and tear and the other stuff, uh, which can cause um, problems in the machinery. So we need a major repair after 4,200 hours. The machine is expected to last for 8,400 hours. So the expected time for this machinery is 8,400 hours. Like the use hours, it can be used for 8,400 hours. After which it would be sold at a price salvage value, which is 10% of the original purchase price. So salvage value is 10% of this price. This is the purchase price. A final set of new tires will not be purchased before the sale. So finally, when uh, we have to sell the machinery or the salvage value, so we don't have to purchase the tires. So in this example, we have to calculate how much should the owner of the machine uh, charge per hour of the use. How much he should charge for per hour of the use if it is expected that machine will operate 1400 hour per year. So the 1400 hour, it is the maximum use which an owner can get use of it. It's 1400 hours. So we have to find out that how much he should charge per hour. The company's cost of capital rate is 7%. So in this problem, we have certain data which we have to analyze. First, we have to review this. Like we have $45,000 of the machine cost. This is $12.34 is operating cost per hour, and we have to replace the tires after every 2800 hours, which costs $3,200. Similarly, a major repair of $6,000 is required after 4,200 hours, and the total machinery can be used for 8,400 hours. The salvage value is 10%, and the company's cost of capital is 7%. So the first thing which we need to find out in this example is that what is the total life of this machinery with the owner, or usable life of this machinery. For usable life of this machinery, as we have this total life, total operating hours 8400 hours, and we have 1400 hours per year. So if we divide 8400 by 1400, so we will get the number of years. So first we have to solve for the n, like the life, the number of the years, where n is equal to 8400 hours divided by 1400 hours per year. This is per year. So it comes out to be 6 years. Usually the ownership and operating cost components are calculated separately, as as the tires are considered an operating cost element because they wear out much faster than the other components. Therefore, before calculating the ownership cost of the machine, having these tires, the cost of the tires should be subtracted from the purchase price. So before calculating the ownership, we have to subtract the tires cost from the purchase price. So the machine cost is $45,000 and the tire cost is $3,200. So we got this 41800 cost, like without the tires. Now what we have to do, we have to annualize this cost per year. The annualized purchase expense we have to find out, like a, we have to find out the value of the a, like the ownership cost per year. This is the total cost, like the present cost, p, this is the p value which we have to invest at this moment. So what is the total a, or the a which can be distributed per year for 6 years? So we can use the uniform series capital recovery factor. The equation F which we have used, as we have this value of P which is 41,800 dollars, we have the value of the I which is 7%, we have the value of N which is 6 years. So putting all these values in this equation, we can get the value of A. So we will use this formula here to find out the annual ownership cost, putting all the values in the above mentioned formula, in this formula. So we have the value of the P, we have the value of the I, and we have the value of the N. So let's put all these values in here. $41,800 is the present value, which is invested for buying the equipment, and 0.07 is the annual interest, the I, and 6 is the period of time, like the N. So if we simplify all this equation, we can get 0.2097 value, which we can multiply with the 41,800 and get the final value, which is $8,769. This is the annual purchase expense. If here what we have done, we have divided this whole purchase on 6 years of the time with the interest or capital rate of 7%. So this is the annual purchase expense. Now let's consider the salvage value at the end of 6 years. What will be the salvage value of when the 6 years pass, like the 8400 hours time duration has passed for the working period? So the salvage value is 10%. As we have seen in the question, it has asked 10% of the total cost. So here we will use the total cost 45,000 and we will calculate the salvage value, which is 45,000 multiplied by 10%, so which is 4500. This is the salvage cost. As we have annualized the purchase cost, we can also annualize the salvage value, as this value is the future value, like at the end of the 6 years. So by considering this value as f, we can use the uh, uniform series sinking fund factor equation, and we can find the a salvage, like the annual salvage, choosing this as a future cost or the future value, future amount. So the annualized value of the salvage amount at 6 years in the future can be calculated using this uniform series sinking factor, which is equation D. In the previous equation, if we see, so we have used this equation, this is same equation but in terms of P. So using this in terms of F, because here we have the future amount, the future value. So using this 4500 here, we know that I is 0.07 or 7%, N is 6. Putting all these values in this equation, so we can get the annual salvage value by putting all these values in this equation. So we just have to simplify this equation. So by simplifying this part, we get 0.1397. We can multiply it with the 4500. So we get $629.02. This is the annual salvage cost, salvage value, annualized salvage value for 6 years. Similarly, the annualized salvage value we can calculate by equation F, which is uniform series capital recovery factor. So to the annualized value of the salvage amount for 6 years in the future can also be calculated using the present worth compound amount factor with the uniform series capital recovery factor. So using this equation F, where p value is equal to f over 1 plus I power n. So here we have all the values. If we put this value in here, so we get this new formula. So through this formula, we can also find the annualized salvage value. F value is 4500, I is 7% or 0.07, and N is 6. So putting values in this equation, we get 4500 F and 1 plus 0.07 power 6. This value, similarly, this is I 0.07, 1 plus I is equal to 1 plus 0.07 power 6, and this value. So if we simplify this, we get $629, which is same as we got from our previous formula. So using either uniform series sinking fund factor or uniform series capital recovery factor, we get the same annual salvage value, which is $629. So until now we have calculated the annualized ownership cost and annualized salvage value. So now let's consider the annualized fuel consumption, fuel operating gas and minor maintenance, etc. So the annual FOG and the minor maintenance cost is 12.34 per hour, which is also stated in the question, and 1400 hours per year we use. So just simply multiply $12.34 with the 1400 hours. So we get 17,276 annualized FOG value. So here, in addition to the original set of tires, two sets of the replacement tires will have to be purchased. One set after 2 year into the life of the machine, and the second set at 4 years into the life. The 2 years, because in the example, if we go and we see, it says that tires have to be replaced after 2800 after 2800 hours of use. Let me show you that. So here it's a set of the tires costs $3200 and has to be replaced after 2800 use hours. So using the present worth compound amount factor with the uniform series capital recovery factor, like this formula we have to use. So 3200 is the initial cost, like without, this is the initial cost. As you remember from the $45,000 we have and subtracted this amount. So this is the initial purchase when no time has passed. So this is when 2 years have been passed, and this is when 4 years have been passed, or we can say when 2800 hours have passed, and when 2800 plus 2800 5600 hours have passed. So we can use this formula. So that's why it's 2 years, and 5600 hours it's 4 years. So that's why we are using this. And in this region we have the um, 0.07 I, and N is the whole total time, 6 years. So just simplifying this, we get 3200 plus 2795 plus 2441, and we have to multiply it with 0.207, 0.2097. So we get the annualized tire cost as 1769.89 dollars. To annualize the tire replacement cost, these future point in time costs must be made equivalent to the present amount at time zero, and then the resulting amount is annualized according to 6 years life of the machine. To do this, we have used this formula. So until now, we have analyzed three things. The first is, and we have analyzed the ownership cost, then analyzed the salvage, and then analyzed the tire cost. Now we have to analyze the cost for the major repairs 3 years into life. To analyze the cost for the major repair 3 years into life, we again use the same formula. We know that the F value is 6,000, and in the question if we say see, so the major repair will be required at the cost would be $6,000, and at the time of 4200 use hours. So 4200 use hour is 3 years, like half of the time spent, as 1400 hours per year. So 1400 hour multiplied by 3 is 4200. So by simplifying the values which we have put in this formula as F as 6,000, because it is in future after 3 years. That's why it's F here. So if we simplify this, so this portion comes out to be 4897.79, and this portion, if we simplify, so it comes out to be 0.2097. Just multiply these two, so we get the annualized major repair cost as $1027.54. So now, until this point, we have calculated four annualized costs. One is for the ownership, the other is for salvage, the third one is for tires, and the fourth one is for major repair. And also the fifth one is for FOG, like the um, fuel, oil, grease, and minor maintenance. So the resulting total annualized cost, if we see, is this one. So 8769 is the ownership cost, and the salvage cost we have to deduct because this is the cost which we will get back. So that's why this is minus. So similarly, 17276 17276 uh, dollar is the annualized uh, fuel, oil, grease, and minor maintenance, and 1769 um, is the tires cost, annualized tires cost, and 1027 is the major repair cost. So if we add up all these, we can get the annualized total cost. So by summing up all this, we get 2821.3.81 total annualized cost. So this is the total annualized cost which will be used. So as in the question is also that we have to calculate the cost per hour. So in every year we have 1400 hours, as in the question it is stated that. So we just have to divide this $28,000 by 1400. So the total cost per hour we can calculate is 2821.3.81 hour per year divided by 1400 hours per year. So the total cost comes out to be 20.153 per hour. So this is the total cost per hour which is required in this case. So if we have the company's capital risk is 7% and 1400 hours per year of the use, the owner should charge at least this amount, $20.153 per hour for the machine to justify the cost of $14,000 for the purchase. So this is for the today's lecture. In the next lecture, which is also the continuation of uh, this equipment economics, we will discuss cost of capital and discounted present worth analysis. We will also do an example on it, and then the elements of the ownership cost. There are different elements of the ownership cost, which include the purchase expenses, salvage value, tax saving from depreciation, major repairs and overhauls, property tax, insurance, storage, and miscellaneous. So we will be having some examples on that, and also we will discuss these in detail in our next lectures. Similarly, we will also discuss the elements of the operating cost, which are fuel, lubricants, filters, repairs, tires, and replacement of high wear and tear items. So we will be discussing all these things in our next lecture, which is also the continuation of equipment economics.